Hello, John Gillespie here with Occam's Investing. Today we're going to talk about a valuation of a very popular cybersecurity company called CrowdStrike. And I'm running the valuation for it. And oh, surprise, surprise, it comes up as a sell. And that's the discounted cash flow valuation. Many of the high growth tech companies will come out and as sells because the market prizes them, and as the market price is $392, but the intrinsic value is only 119. So if you truly believed that the assumptions that made up this cash flow estimate of the weighted cost of capital, a growth rate of 4.2%, that you wouldn't want to be invested in this because your margin of safety is about 70% overvalued. But from the Occam's models, we view it as a healthy company because it's got very strong cash flow. In our system, instead of just getting one or two buy, sell, or hold estimates, you'll get the discounted cash flow. If you choose to run it, you can get a relative valuation, a peer valuation, and the Occam scores. And then you'll have the AI analysis. Our forensic jury will tell you a little bit about what it believes is happening in the current market and why these valuations may or may not be so accurate. So Occam's and Peter Lynch basically would classify CrowdStrike as a stalwart company. It's been around for a while, and it's doing better than 15% earnings on a regular basis. Its last quarter was 21%. The Buffett metrics, 6 out of 7 metrics pass, so they're doing pretty good from both of these legends in investment society. But in our model, we ask you to rate your risk profile. I rate mine as aggressive, so it tells me that it's conditional, that I would size my position based on this, how strongly or what my conviction is in the story once I analyze everything or read everything that it's provided, right? So we have a little card here that says, what would Warren Buffett do? So based on his 6 out of 7 metrics, he probably will pass, and because it's close but not clean, he'd want the net margin to be greater than 20%. So he'd pass before he committed. And can kind of keep scrolling down and tells you a little bit more about we have moderate confidence that it would be a sell rated just because it's so highly valued by the market over the DCF. But the Occam's models based on the rule of 40 cash flow scores, 50, 55 plus, we rate it as healthy. It's a healthy company, and it's got great cash flow and low debt. Low debt's something that Buffett likes as well. So then we get down into the AI narrative. So CrowdStrike operates in a highly competitive cybersecurity market, specifically endpoint detection and response EDR, where it has established itself as a market leader through its cloud-native Falcon platform. So they demonstrate very strong fundamentals with an impressive 21.7% revenue growth, reaching $4.8 billion in the trailing 12 months, with an exceptional rule of 40 score of 55.2. Its robust free cash flow generation of $1.3 billion despite reporting a net loss. This pattern's typical of high-growth software as a service companies prioritizing expansion over short-term profitability through heavy investment in R&D along with sales and marketing. Though the company does maintain a fortress balance sheet with $5.2 billion in cash against only $820 million in debt, providing its substantial strategic flexibility. So if you are a growth investor, all these things are a big deal because while the price can be volatile, if it continues on with this type of rate, it'll be a moneymaker in the long term. Right? So the DCF assumes 14.2% perpetual growth, which appears aggressive given the company's current size and market maturity trends. And what that means is it's hard to keep up the high growth that they're just, demonstrating at this point over the long period. Basically, the bigger and bigger you get, to get those percentage gains gets more and more difficult. So it's got a perfect Occam score, though, of 100. No zombie or divergence flags, exceptional cash generation metrics that demonstrate genuine business quality rather than financial engineering. A lot of times you'll have companies that are focused on EBITDA, and they'll be really hiding the fact that they're not generating cash. This company truly is. And then we get down the AIs do what we call signal reconciliation. So, when there are any disagreements between the DCF, the Occam model, and the AIs, the forensic jury will kind of tell us a little bit about what they came up with. So I trust the forensic cash flow signals more than the current market price, but view the DCF as overly conservative. Right, so the forensic indicators confirm this is a genuinely high-quality business with sustainable competitive advantages and strong cash generation capabilities. The company isn't financially distressed or employing accounting gimmicks. However, the market price appears to discount an unrealistic growth trajectory that leaves no room for execution missteps or market maturation. The truth likely lies somewhere between the DCF and the euphoric market pricing. This is an excellent business trading at an unsustainable valuation. So in the end, what the AI is saying is keep an eye on it. And if it pulls back and the market gives you an opportunity, there's probably going to be better times to jump in. And you can continue on. They give you more of the recent developments, the bull case, the bear case, and then the details of the Buffett validations. As you can see, they're a high-quality company. Their net margin is less than 20% because they're investing in growth right now, and the DCF assumption. So all of the data is out there and clearly marked for you to evaluate. In Occam's, we don't expect people to want to be pulling out their calculator. It takes a lot of time to do these things by hand. When I was in school, it could easily take me 15 to 20 hours to do a quality discounted cash flow and document it very well. The average person doesn't have that time. But if you're trying to get ready for retirement, it's important that you at least consume this type of information. You could read this and understand it probably in less than 10 minutes. And is your retirement worth investing 10 minutes? Or would you rather invest your money based on what somebody said online or some financial advisor who's taking some percentage of your retirement funds every year? I think it's easier to come onto a platform like Occam's and figure it out that way. Anyway, join us. We have a community. We have chat sessions, live meetings, and discussions. So if you're a part of the community, you can ask questions, and the community will discuss it, and hopefully everyone walks away a little bit smarter.